It's June 4th. We're sitting down with CEO of VanEck, VanEck, and we're speaking amidst one of the most turbulent and volatile periods in recent market history. May just saw one of the strongest performances for the S&P 500. We're now trading at near all-time highs once more. What's next? We're diving into VanEck's outlook for the markets, economy, and Bitcoin. An honor to host you. I've read so much about you and your work, Jan, and I've had your colleague Matthew Siegel on the show a couple of times. So it's a great honor to finally host the man behind VanEck.
Oh, it's good to be here, David. Thanks.
Let's just start with the broad market outlook. Like I mentioned in the introduction, the S&P 500 posted its best May performance since 1990, gained over 6% in just 1 month. You told CNBC in April that investors should shift away from U.S. equities due to geopolitical factors. Can you just elaborate on that and why you think people should be shifting away amidst one of the strongest bull rallies in recent history?
Yeah, I mean, listen, I think there's one big macro overhang, and we're almost like the calm in the middle of a hurricane, David. It feels good, feels normal, feels quiet. I mean, even things like Bitcoin have low volatility right now. As you said, the market's retraced all its losses, so we're kind of flattish on the year. But we've got this big macro overhang, which is our budget deficit, and we just don't know how it's going to shake out. Now, let me put some context around that really quickly. The U.S. budget deficit, I'm not going to recite all the statistics. Everyone knows that our budget deficit as a percent of GDP is unsustainable. That's basically the fact. I mean, unless the government ends up buying all the debt that we need to issue, we can't continue at this pace. And the question is, will Washington cut that ratio significantly, or will the markets, bond vigilantes come out, freak out, and drive the 10-year up to, something scary, 5, 6, 7, 8%, because only that will then force Washington to stop spending money. We don't really, it's a little bit we don't know what's happening with the Senate negotiations. Everything is behind closed doors as far as I know. So we just have to do a little bit of a wait and see. But the reason I was bearish on equities is only that I figured that we would have to cut spending to a certain extent. We just can't have what I've been calling 2 feet on the gas pedal. And so that would lead to lower economic growth and therefore a little less support for equities. So that's sort of that's the overhang. Timing is everything is super tough. So I'm not saying get out of the market. I'm just basically saying expect that there'll be less fiscal stimulus in the second half of this year. And the administration has basically said they are willing to absorb that. I mean, Trump even used the word recession several months ago. Besson has talked about deleveraging and normalization. So that's where I think we're at.
You talked about in Q2 2025, in the middle of a 3% reckoning in your April outlook. What do you mean by reckoning? What is this 3% pullback you're referring to?
Sure. So I've called 2025 the year of the reckoning for about a year now because Americans are on an unsustainable debt path, as I mentioned. People say, oh, we'll never default on our debt. Our Social Security system in 2033 will cut payments. So let's call it go bankrupt in 2033. And you can't fix a retirement system at the last minute because you're dealing with so many people and so many liabilities that need to be adjusted. So the United States has this habit of only addressing major issues the year after a presidential election. So here we are, there's 2 presidential elections before that Social Security default, 2029 and 2025, right? And so that's why I said this is kind of it. And we're not even talking about fixing Social Security. That effectively means that we are slow marching towards a default of Social Security. Again, payments will only be cut to 80 cents on the dollar, but when you don't pay back 100 cents on the dollar, last I checked, that's a default. So that's why I say we're in the middle of this reckoning this year. This is the time, especially with the sweep of both the House and the Senate by the Republicans, to fix this policy issue or not. And if we're not going to fix it, then there will be, I think the markets will call for a reckoning. So I know that's a little bit of a, we don't know the outcome situation. It's where we find ourselves in. The risks are clearly that Americans need some protection in their portfolios, which is why we talk about gold and Bitcoin, which are in multi-year rallies, hitting all-time highs both this year. And that's what people should be doing in their portfolios, protecting against this potential outcome.
I'm going to get to gold and Bitcoin in a lot more detail in just a minute, but you also highlighted the importance of India as a diversifier. Why India?
Sure, that's another kind of multi-decade or multi-year perspective, right? So if you look at India's major business reforms and digitization under the Modi years, they are really set to become, at current growth rates, they will be as big as Europe in about 10 continental Europe in 10 years. So they're really set to become the fourth major consumer market in the world, right? The US, Europe, China, and India. And so when you have these two large centers of economic activity in Asia, China and India, they are not at all in the US dollar ecosystem, right? They want to de-dollarize their economies. And the implications are good for global growth, but they also mean that the world will continue to look for an alternative currency to the dollar. And that alternative currency is gold. So the India growth story has two implications. One, for shifting global growth dynamics, and second, this kind of slow but consistent year-over-year pull towards an alternative to the dollar.
Gold and Bitcoin. Let's talk about that. Diversify assets for sure. Gold, I understand, but let's talk about Bitcoin first. Bitcoin is very heavily correlated with the S&P 500 and in particular the NASDAQ as well. Why Bitcoin as a protection against this reckoning?
Great question. So Bitcoin historically, until COVID, had 0.0 basically correlation to financial assets. It was an unbelievable thing to add to your portfolio because it was providing tremendous returns and acting as a diversifier. Since COVID, you're absolutely right. The correlation to the NASDAQ has increased and it's become a little bit more of a risk on asset if you look at sort of traditional financial metrics. I just think that it has still both assets, gold and Bitcoin, if you take a step back, are still acting as diversifiers. And you just have to ignore that the correlation is higher. So we will see whether that continues in a crisis. But my basic belief is that kind of in the intermediate, don't worry about day-to-day moves. That Bitcoin and gold will both in secular appreciation cycles.
I'd like to take a minute now to talk to you about a great way to buy physical gold through a trusted dealer. Our sponsor today, One Gold. Launched by trusted industry leaders in AppMex and Sprott, One Gold allows you to own vaulted gold, silver, and platinum in your choice of secure vaults around the world. With One Gold, your holdings are fully insured, audited, and IRA eligible. One Gold is an intuitive and secure alternative to precious metals ETFs and offers an array of unique investment tools like the bullion card, auto invest, limit orders, and more. Thousands of customers are using One Gold as a complement to their physical assets using their regular at-spot promotions. Additionally, One Gold offers unparalleled liquidity with same or next day cash withdrawals, 24/7 trading, and physical redemption. Get started today with a few clicks from onegold.com, link down below, or scan the QR code here, or by downloading the One Gold mobile app in the Google Play or App Stores. Well, what is the thesis behind Bitcoin? How should investors perceive Bitcoin? Is it a risk-on asset, like you said? Is it going to be a diversifier? Is it going to be a hedge, meaning it will go in the opposite direction if the S&P goes down? What's the thesis right now in 2025?
Well, I think the thesis is always that these are stores of value because the supply is effectively fixed. It's very hard to mine new gold, and we know the Bitcoin, kind of inflation cycle that's programmed into the blockchain, right? So the limited supply makes them a store of value, and that is juxtaposed against the dollar, where if we keep issuing more debt, we're going to keep issuing more dollars. So the ratio should be going up: more dollars to Bitcoin, more dollars to gold. Therefore, the price of Bitcoin in dollars should keep going up. Again, it could be that people in Washington get responsible and that cycle of inflation doesn't become too dramatic, but people are already so worried about it. The credit default prices of U.S. debt are going up, and gold and Bitcoin are keep going up because people want that diversification in their portfolios. There's a school of thought, as I'm sure you all know, David, that says I only want assets that generate income, and that's the dig against gold and Bitcoin, that they don't generate income for the most part. You can generate minor income from both, but so a Warren Buffett will say, all I want in my portfolio is equities because that gives me the top return over time. We say, listen, most investors want total return, sure, but they want it through cycles. They don't want to go through a whole decade like the 70s where they're seeing their portfolios go down all the time. I mean, they were upset enough in April when they went down for a month, right? So that's why you would want to blend in some gold or Bitcoin into your overall portfolio to give you a smoother ride.
Well, is there any particular reason why you're focusing on Bitcoin as the digital gold and not any other alts to satisfy this particular purpose?
Yes. I mean, it's just sort of there's no logic that Bitcoin has become the asset of choice in the crypto ecosystem, but there's clearly no competitor. And the more and more usage by more and more millions of people globally, it just makes it that thesis continue.
Well, how is VanEck catering its ETF offerings around this thesis?
Yeah, I mean, generally, in two ways. Generally, we've had a dialogue like this, David, with investors saying, this is our outlook on the world. This is what we think can accentuate the return in your portfolio or reduce risk. Um, and that's why in 2017, we filed for a Bitcoin. We were the first ETF issuer to file for a Bitcoin ETF. So we offer Bitcoin as a standalone solution. Our ETF symbol is HODL, HODL, which means be a long-term owner. The second way we offer it, so just to continue, the second way we offer it, financial advisors in the United States are often using portfolio models, meaning they don't pick the fund manager or even the fund. They say, okay, I will trust BlackRock or VanEck to put together a portfolio for me. We offer that service as well. And so because we've been including Bitcoin last year, especially, you can imagine those users of those models are excited that we used Bitcoin, and we use it moderately, 2 to 5% allocation in an aggressive growth portfolio, but it adds to returns, as you know.
In the early days of your conversation around issuing, well, right before you issued the Bitcoin ETF, or at least filed for it, who did you have in mind as your target demographic? Presumably, you thought that the people buying this Bitcoin ETF would be different from people buying spot Bitcoin. Otherwise, why would they need this product?
Uh, well, VanEck has a very strong brand and client base in what I call store of value investing because we were the first company. VanEck is 70 years old. We were the first company to start a gold fund in the United States in 1968. So back then, gold was pegged against the U.S. dollar, $35 an ounce. And that mutual fund was the best performing mutual fund in the 1970s when gold went from $35 to $800 an ounce. So we've been known for that in the ETF world, which we got into 19 years ago. We launched the first gold-oriented ETF, which was Gold Mining Shares, GDX, and its companion GDXJ. So it was partially already back in 2017, having conversations with those investors. They liked Bitcoin. They don't mind the volatility of investments, David, because they know they're not putting their whole portfolio in gold or Bitcoin, right? They're sizing appropriately.
Well, for the average investor who, well, they have, I guess, a few options. They can either buy an ETF like one of VanEck's offerings, or they could diversify themselves. And so if they could do that themselves, which is to diversify, why or what should they be looking at in terms of asset allocation right now?
You mean in terms of how much Bitcoin should they own?
How much Bitcoin versus gold versus stocks versus Bitcoin? What's an appropriate allocation for 2025, do you think?
Yeah. So we've been basically, I quote unquote pounded the table on gold and Bitcoin in 2023. And so we've been, as one of my colleagues said, have gold coming out of our eyes in terms of our allocation models. Gold has just performed so well and its volatility is low. So you put it in an optimized portfolio, you're going to be owning a lot of gold. Generally, we invest in about 10% of our overall portfolios in real assets. Gold would be one of the biggest weightings in that. And then much smaller would be gold shares. So that would be sort of like a 3-to-1 ratio in terms of gold bullion to gold shares. And then, Bitcoin would be part of that as well.
Do you see geopolitical risks fading such that it would bring down the geopolitical risk premium of gold and perhaps bring gold lower?
Yeah, listen, I felt at the end of Q1 that gold's run up needed a pause, and I think it's been working sideways nicely, which is kind of what you want to see in an overall bull market. It did correct up to I think 14 or 15%, and it obviously rallies on big days when there's a tension between Ukraine and Russia or whatnot. But I think of political risk as essentially uninvestable. It's unpredictable in the short term. So I kind of don't do our allocations based on any of that news flow.
All right. Fair enough. Tell us about a new offering, GPZ. It's your new ETF. It allows investors to buy shares in major firms that manage private equity. Walk us through this particular new product that's launching and why people should pay attention to this.
Yeah, well, the big picture is that a lot of companies now are staying private, and there's a lot of lending away from banks, and that's happening through hedge funds and private credit vehicles. And so there are famous asset managers, Blackstone, Apollo, Ares, that effectively specialize in these private asset classes. So the theory of our ETF, like other ETFs, is just to have a pure play by investing in the managers of those private credit and private equity funds. And so I mentioned some of the big constituents. You'd think that this ETF would already exist, David, to be honest. But some of them, the existing ones out there, include not just the manager, right, who earns the fees on the funds, but also some of the funds themselves, which we don't get, or they invest in the private equity managers, but not the private credit managers like a Blue Owl. So anyway, it's a pure play fund. Yeah, the ticker symbol is GP, as in general partner, and then Z just to make it zingy, I guess. So
GP for general partners and Zing for zinger. All right. So why would an investor not just buy Blackstone directly, for example? It's a publicly traded stock. What's the appeal of this ETF versus just buying the underlying directly?
yeah, sure. No, it's because it's more diversified. I mean, that's really it. It's a play on the sector. I will say that its overall return is sort of has a high beta, if you will, meaning it really outperforms the stock market on the upside. The thesis of the fund, I should have made this clearer, is that right now private wealth has about like wealthy individuals in the US, in other words, have about 2% of their assets in private credit and private equity. And people are really projecting that to grow to maybe 10%, right? And so that's why a Vanguard and a Fidelity and a State Street are partnering with these managers to offer these strategies to their clients. So the theory is this is a secular trend. It's already seen tremendous growth over the last decade, but that it has, much more to go.
So let's say an investor wants to be exposed somewhat to, let's say, SpaceX, valued at over $350 billion, or Stripe, for example, valued at over $90 billion. These are private companies that have stayed private. How do we gain exposure to some of these large tech giants that are private?
Oh, that's a separate issue. I mean, I'm assuming we're talking about an average investor that is not writing multi-million-dollar checks to these private funds themselves and is not an institution. There's a new category of funds coming out there called interval funds. We're actually looking at doing one ourselves that effectively bring the access to those private companies, to your point, to the kind of, let's call them average investor. It's kind of crazy, right? There's 1,000 private unicorns, meaning 1,000 companies in the United States that are worth $1 billion or more, and many have no need and no intention of going public. So yes, you're right. Like if we're an ETF provider, and someone said, "Whoa, there's this asset class," I'd be, yeah, let's provide access to it. So great question.
Could you, in theory, design a product that could gain exposure to private equity firms that are financing or are involved in some of these large companies?
Well, that's what the new ETF does, right? It's private equity and the public ones, private equity and private credit.
Okay. What about the private ones? Any way to gain access
Oh,
to
the
that?
private ones? Yeah, no way.
No.
I
Okay.
mean, usually those are just owner operated, right? Meaning the partners own all of the economics.
What is the rough exposure to or sector overweight for GPZ that we can expect? Is it more tech heavy, financials, information, healthcare, so on and so forth?
It is more oriented towards private equity than credit, but that's about all the specificity I have right now on an industry basis. We haven't kind of rolled that up, but that's a great question. We'll do that.
Another product I'd like to talk about is pertaining to nuclear energy. You have a ETF that kind of tracks or is exposed to Trump's nuclear energy policy. Can you explain that?
Sure. Yeah, I mean, look, there's a dramatic 180 in, I would say, almost global policy towards the acceptability of nuclear power. The beauty of nuclear power, right, is that it's on 24/7 and it doesn't produce any carbon emissions. So it's quote unquote, from that perspective, environmentally friendly. But it was really politically toxic for many decades after 3 Mile Island. What happened last year with the Biden's infrastructure and environmental spending legislation started supporting nuclear power. And you had Democratic governors in Michigan, Delaware, and California suddenly supporting projects extending the life of nuclear reactors. There is a new technology as well that's doing smaller scale nuclear plants, if you will. Those are called SMRs. So what our ETF does is basically it's a holistic play on the sector. It has the utility companies that are using nuclear energy. It has those technology companies like the SMRs, the ACLAs that are looking to offer nuclear power in these smaller units, and it has some uranium miners. So it's a kind of most holistic play on the sector. And some of the stocks, the SMR stocks, did extremely well. Just to quickly, Trump a couple of weeks ago announced three or four executive orders on nuclear power, including use of federal lands, because one of the big issues is not in my backyard, and also revising the permitting and speeding up the permitting of some of these newer technologies. These technologies are actually being used in China and in the UK. And I think part of the impetus, David, is that China has radically reducing the cost of electricity there through the use of nuclear energy. And we're like, we cannot have energy that's twice as expensive as China and expect to compete, because the cost of energy, just like tariffs, go into absolutely everything.
Well, investors want to be invested in change. So, how would you evaluate the change in attitude towards nuclear energy from this administration versus the previous Biden administration?
Yeah, listen, I mean, I think that these stocks have been revalued. I mean, let me give you all right, the positive side is that this is going to be that hyperscalers need more electricity. Electricity demand in the United States was flat for several decades, but now because of AI and the big data center needs, we need more energy. So where's that energy going to come from? Our answer is, in the short term, natural gas plants; in the medium to longer term, nuclear. So that's the bull story. The bear story is, everyone, this has already been priced into the stocks, right? They're slightly expensive. And look, no matter how fast this stuff moves, it's going to take 3 to 5 years before a lot of these plants come online. So there's a lot of room for investor disappointment, David. And you know that investors are picky. So that's the bear argument for these stocks. So I think you have to look at the upside and downside. But I think overall the thesis will be that you're going to have faster acting regulatory enablement of these of this sector of the economy. So that's why I tilt slightly bullish on this argument.
Right. Well, going back to markets, and we'll finish off here. So, You're generally diversified across equities, I think is your thesis here. How does this play out relative to monetary policy? In other words, do you see the Fed doing anything this year that may change your outlook and your stance?
Well, okay, so couple scenarios. If they cut spending, that really allows for what I've called a grand bargain with the Fed, because if they cut spending by 3% of GDP, then that will definitely slow the economy, and that gives the Fed room to cut rates, which would stimulate the economy, right? So that's one scenario. The other scenario is nothing much happens. They don't decrease the budget deficit, then rates will stay higher for longer. Where I prefer to have shorter duration in my fixed income, those things like CLO ETFs and what have you, is because I'm not optimistic about Washington. So I'm just really worried that, that 10-year interest rates might spike. So I'd rather not have that risk in my portfolio, especially since now I'm getting paid for, 4.5 or so on the short end.
Do you think the consumer right now, the American consumer, needs stimulus? So Elon Musk, for example, he recently left Doge, or is in the process of leaving Doge, and he just recently criticized the Big Beautiful Bill as setting back a lot of the spending cuts initiatives that he tried to work on. In fact, he thinks that the budget deficit will widen even more after this new bill comes into fruition. So how do you balance that? On the one hand, you've got the priorities of balancing the budget and reducing the deficit. On the other hand, perhaps the consumer needs this bill. Where do you stand?
Okay, so again, I think that if constructing a portfolio, you have to be ready for all outcomes. But you asked me my opinion, so I'll give you my opinion.
Okay.
My opinion is that they are going to be much more aggressive about cutting the budget deficit than people are fully appreciating. And so I think that Elon is not speaking out of turn from the Trump administration, but he is. There are a lot of Senate hawks, and there are a lot of people in the technology industry that flipped parties and supported Trump that are extremely worried about the federal budget deficit. I mean, it is really weakening America. And so I think they will end up being much more successful in cutting spending and cutting the deficit than people realize. Again, that might risk slower growth in the second half of this year, but that's still a year away from the midterms, and I think that's very much part of Trump's plan for the first 2 years. But I honestly don't have much evidence because all this stuff is happening in the back rooms, David.
With the U.S. 10-year yield now above 4.35% and the S&P just under 6,000 points, investors may look at this and say, well, the markets are pricing in some sort of economic boom and not a recession. Would you agree with that statement?
I think the markets have run up a lot in the last 2 years. Earnings growth has been solid so far this year, right? And ultimately, that's the driver of stock market prices. So I think it wasn't unnatural to say that PE ratios would come down, so that where we're at now makes a lot of sense to me, as long as there are no big macro shocks, either from fiscal policy or tariffs.
Okay. If you had to place a bet on the best performing asset for 2025 for the remainder of the year, what would it be?
Bitcoin.
All right. Look at Bitcoin then. That's the theme of our conversation. That's our takeaway. Thank you very much, Jan. Where can we follow you and your firm and your work?
Yeah, on Twitter, Jan VanEck 3, the digit 3. VanEck.com has our outlooks that I publish every quarter. So appreciate your interest.
Well, I appreciate you coming on the show and educating us, Jan. So we'll put the links down below, so make sure to follow Jan and VanEck's offerings there. Thank you very much. We'll speak again soon. Take care for now.
Okay.
Thank you for watching. Don't forget to like and subscribe.